Welcome to the Asset Management Resources Economic and Market Outlook for the second quarter of 2022. Welcome and thank you for attending. I'm Chris Boyd, founder of Asset Management Resources, and I'm joined today by Brian Regan, our firm's Chief Investment Officer. In our webinar today, we'll be reviewing the portfolio results and looking backward and strategies for the upcoming quarter. We are recording the webinar and your participation implies consent to be recorded if you should ask a question or comment. We will be including some compliance language at the end of our presentation, but suffice it to say that opinions are subject to change, but information has been derived from sources thought to be reliable. You know, every day it seems like we're bombarded with news, and often it's bad news. Horrible, views of war in Eastern Europe, conjuring images of World War II. Tensions with Russia build and imply the start of a new Cold War era. Yesterday, we saw coverage of senseless violence in New York City. Bad news can be disheartening. And yet, 1 week we have the lowest weekly jobs claims in more than 50 years and a fantastic unemployment rate of 3.6%. And the next we find prices are rising rapidly with an 8.5% inflation rate according to CPI, or even 6.5% for the so-called core inflation. Let's face it, anyone watching real estate prices or gas at the pump or their grocery shopping receipts sees and feels prices on the rise. To further the confusion, how markets react to what seems like bad news can be good, and other times markets respond poorly to what seems like good news. It can be challenging and confusing to be an investor. Today, we're going to attempt to provide you perspective on the issues of the day that impact investors, and generally how we are managing risk and opportunities with our discretionary portfolios. We'll talk about inflation, certainly on everyone's mind. We'll talk about the Federal Reserve and its policies. We'll address increasing speculation about the challenging prospects for a future recession, and how we are positioning portfolios with stocks and bonds and other asset classes. Investors want to know, should we be positioned more cautiously? Does it make sense to invest in bonds in the face of what seems like destined to be rising interest rates? And with so much uncertainty in the world, are stocks doomed to fall? We hear these questions from clients, prospective clients, and our radio listening audience each week. We're sympathetic to the frustrations and concerns that people have, and today we will endeavor to share our thoughts about how best to navigate turbulent times and why we remain enthusiastic investors. So let's get started. Our agenda today, we are going to be reviewing the first quarter. We'll certainly be talking about inflation and growth. What's the outlook for the domestic equities? We'll talk about bonds, certainly. The notion of a point in time for performance assessment, investing for the long term, and risks and opportunities, and our takeaways for you. You may have questions throughout, but we're allocating time at the end, certainly for questions, but feel free to use the Q&A button as part of your panel to ask your questions and comments along the way. We'll try to address them if they're right on point in the midst of our content. Otherwise, we'll reserve time for the end. If you prefer to ask a question verbally, you may raise your hand. The webinar will be posted on our website and a YouTube channel later today. In fast-changing times, though, we encourage you to listen to our radio program and podcast because things can change and we want you to be in tune with what's going on. All right, with that, let me turn things over to Brian Regan.
Thanks, Chris. Hi, everybody. I hope you're all doing well. Certainly an interesting quarter, and look forward to getting into it here. So let's start by looking at the major index performance over Q1. As you all know, I spend most of my time talking about stocks being for the long term, so take all of this with a grain of salt, but it's still interesting nevertheless, given the quarter that we had. The markets came in at a high at the beginning of the year. This is through March 31st, by the way. But it eventually turned into being a rough quarter for stocks. Now, a rough quarter after a long bull market. So let's keep that in mind. At the beginning, international stocks held up well prior to the war. Then they sold off, and since they've rallied some, and that would be the gold line there. The NASDAQ fell into bear market territory as inflation rose, then fell further after the invasion, but has since rallied off the floor. I heard an interesting data point over recently that said that over the last 12 months, the average drawdown that a NASDAQ stock is in is 40%. So, at the index level, it's doing a lot better than maybe some of the underlying index stocks are doing. So that was the outlook. It was a little bit of twist and turn. It looked really ugly there for a while, and I think we did our March 13th webinar, March 14th webinar for financial planning. We had some optimistic things to say about the valuation in the stock market, and from our voice to God's ears, it seemed like the stock market gave a little bit of a rally right after that. So let's revisit some of the things that we talked about in that webinar on March 14th. Obviously, there's a war in Ukraine. As Russia invaded Ukraine, the economic sanctions are overwhelming, putting Russia essentially into a Great Depression. The things I want to concentrate here is that the sanctions on Russia will disproportionately fall on the EU and China, as they do most of the trade with them. Now, most importantly, what kind of assets will be directly affected? Well, food stocks, oil, and natural gas are the commodities most affected by the war. Inflation caused by supply shocks are generally out of the Fed's control. Prior to the war, we were looking at the inflation situation similar to a 1946-1948 situation where troops came home from war, had some money in their pocket, were spending overwhelmingly on goods that haven't necessarily been produced yet. And that dissipated over a few years. But now, after the war and the supply shocks, we have to think more similar to the early 1970s situation, starting with the oil embargo after the Yom Kippur War. Before I move on to this slide, I just want to make one last point. The Fed really is faced with two choices here, since a lot of this is out of their control. They can accept higher inflation, which is possible. We have high inflation now, or they can slow down economic growth to meet new supply. So supply has fallen significantly. They can decrease the demand side of the equation. And, I think that is partly what is worrying a lot of people in the financial markets today, that latter point. Now let's talk about the market performance post-invasion. Believe it or not, it's pretty good, especially for the NASDAQ and the S&P 500. Like we mentioned there was immediate sell-off following, but then prices kind of got really attractive, and they've rallied since. This is through a couple days ago, through Friday, and they're positive 4 to 5%. Now, inflation has hit longer-term investment grade bonds the most. So we're seeing down almost 4% there since the invasion. And that's a reaction to the increased inflation that we just talked about. And the international stocks, the MSCI equity ex-US is also down. I don't really think there's much further explanation needed on that one. So let's talk about inflation and growth. Last quarter, we had a theme. And our theme was, let's remind people that stocks can go down, that bonds can go down, that markets can be volatile, because it's been, I think it was 21 months before we saw any significant downturn following the pandemic. And we expected choppier markets in 2022. Unfortunately, we've been right plus some. The market has been even choppier than we expected. And I think what in our theme this quarter, I want to reiterate that I think that theme from first quarter still applies. But we have a new theme here in the second quarter, and it's called fire and ice. So what do I mean by fire and ice? Well, inflation, wages, and employment are on fire, while forward growth is expected to cool. And these are two things that are kind of hard to wrap our minds around, right? It's very easy to get a job, almost as easy as it's ever been. Inflation's high, wages are through the roof. We'll see the data points on this. But at the same time, the bond market's expecting forward GDP to cool. The Atlanta Fed is expecting forward GDP to cool. The Federal Reserve is actively trying to work against these things. We're seeing government spending decrease significantly from 2021 into 2022. These are all things that are going to cool the economy down. And our goal here is to make sure that we're positioned for both the fire and the ice. Let's talk about inflation. These numbers are a little bit out of date now. We got some more numbers yesterday. There was good news and there was bad news. So let's talk about what the difference is between core inflation and headline inflation. Headline inflation includes food and energy. Now, the reason why the Federal Reserve doesn't worry too much about food and energy or doesn't use it as a data point is for two reasons. One, they think they have less control over it. They don't really have much control over the crops that people plant, the oil that gets sucked out of the ground. There's a million different variables that go into it. So they kind of take it out of their consideration set. That's not to say that we don't have to spend money on those things. So it's certainly something to consider. But as far as the Federal Reserve goes, you have to discount it. Now, core inflation is pretty much the same measure, but it strips out those things. So what are big components? Well, durable goods, cars, used cars were significant. But also healthcare, education, things like that are all rolled into core inflation. And obviously there's a disconnect there. And what we're seeing in the most recent report is that the core inflation part might be cooling a little bit. I think it's one data point. One data point doesn't make a trend. So let's be careful about that. But the market reacted to the fact that it's cooling. You see freight costs are down. You're seeing costs of used cars are down. But compare and contrast it to the fact that energy and food were up rather significantly. I think food was up 9%. I think energy was up 11%. And you don't need to be a rocket science to figure that one out. I think Chris did a good job at the beginning mentioning that we're all seeing it, no matter where we go. The problem is, what can the Fed control here? It's a lot of it's out of the Fed's control. So they could do a better job of controlling the core, and I think that's what they're gonna be concentrated on. They can't do much about the headline, and there's a good 2% in inflation in the headline that's not in the core, and that's going to be a little bit out of their control, and it's going to be a little bit frustrating. So, they might accept the higher inflation, headline inflation, while trying to control the core. Now, they do need to raise rates in order to control the core, but we've seen some declines in freight, for example, recently. I mentioned the used cars were down rather significantly. So there's some indication that they can have some ability to control that. Obviously, mortgages are much higher now. If you want to go get a mortgage, you're looking at 5%, 3% on a 30-year mortgage. So that should bring more housing demand onto housing inventory onto the market. But they actually look at owner's equivalence rent. So I don't want to get into the weeds there, but this is an important distinction. Is kind of what I want to get to. So employment's very hot. Over the last few quarters, we've looked at this chart and we've said, hey, there's a lot more people that can come back to work. A lot more people that can come back to work. Maybe it'll put a lid on wages when more people come into the labor force. Maybe they're being held up because of the pandemic. There was a lot of very good data that showed that married women, I surmise that married women with children were a large portion that was being kept out of the labor force. And now we're seeing those people come back in. In fact, we're seeing the number of employed people reach a new high from the pre-pandemic. So that's all good things, right? People are working. The unemployment rate's really low. People are coming back into the labor force. That's great. But the only downside of that is when employment's at its highest, you can expect forward returns for your portfolio to be the lowest. And that kind of makes some logical sense, right? Because the prices on the capital markets are likely going to be higher than when things are good, rather than when things are bad. Wage growth, again, you don't need a protractor to figure out the slope of that line there at the end. We skyrocketed up to almost 6% in wage growth. On the one hand, this is very good for low-wage earners who are now making a significant portion in their paycheck. On the other hand, real wages aren't up that high, because even at 6% growth, it's lower than the 7.5% to 8.5% we're seeing in inflation. So there's some good things and bad things here, but there's undoubtedly this is going to feed into the longer term inflation expectations, and add to our fire and growth theme here. Fire and ice, sorry. So that was the fire. Here's the ice. The Q1 GDP estimate is not nearly as hot as it has been, right? We're looking at almost 2%. The Atlanta is the blue chip consensus. The Atlanta Fed has it around 1.5%. That's a far cry from what we were seeing in 2021, where we averaged around 6%, which was very, very fast. The U.S. economy should grow somewhere between 2.5% is its potential. So we're coming down, and there's a few things that play into that. One of them is government spending. So you can see in 2021, we spent 12.4% of GDP. We were handing out money. We gave out $1.9 trillion in January of 2021. In 2022, we're doing 4.7% of GDP. That's a big decline. It's less paychecks being handed out to people. So that's obviously going to slow down.
And just to be clear, that's overspending, right? Outspending what's coming in. Correct?
Yeah. Right. So this is deficit spending. What percentage of GDP is deficit spending? So let's talk about the domestic equity outlook. This chart here has changed a little bit since we talked a month ago in the financial planning meeting. Back then it was around 18.6 on the forward PE. Now we're at 19.46. But the S&P 500 moved up, 400 points since we had that discussion. Almost 10% since the time when I pulled this chart and we had that discussion. We talked back then about how the earnings were expected to come in around $230 a share. They have not really come in, so that's surprising to some people. I think conventional wisdom might say, people are spending more at the pump. They're spending more on food. They're going to have less discretionary spending to spend somewhere else. Well, that's true, but when you spend more at the pump, that's profit for somebody. And when you spend more on food, that's profit for somebody. And what we are seeing is that margins are continuing to be at historic highs. So, we said it before and we'll say it again. Historically, stocks have been a good hedge to inflation, one of the better ones. So, against fixed income, particularly, the stock market still looks relatively at fair value. So we're at 4,400 today, for example, and you'll see that in the letter that we write, the quarterly investment insights letter. We estimate fair value to be around 41 to 4,400. So I think it is taking into account a healthy earnings expectation. We're still growing from 2021 despite all the headwinds. I'm putting into that 41, 4,400. I'm putting in some continued increase in interest rates. And there's some possible upside. If we have if we have a good earnings season, we could do better than 4,400. I mean, there's a lot of value in these underlying stocks. If we see an interest rate shock, rather in spreads or in treasuries, a continued interest rate shock beyond what I put in here, well, we could have a downward revision. Now, this is all to say that we're going to continue to have a volatile market, which is what we've had, this year throughout 2022 for sure, and what we expected so far.
Brian, before you move on to the next slide on that, one of the things that you commented that on the last slide that, relative to interest rates, this is a reasonable multiple. And you've offered the fair value kind of, where you estimate the market ought to be. Can you first clarify a ceiling versus a floor with that number? Like the fair value isn't necessarily a floor or a ceiling, what that might imply. And then secondly, when it comes to the expectation that interest rates may rise, at least on the short end of the curve, how does that factor into, the changing dynamics of thought process about this multiple?
Yeah, so on the first point, thanks for bringing that up, first of all, because I have it in my notes here, but apparently skipped right over it. When I say fair value, I mean that average historic returns going forward should be expected. Not outside, it's not a ceiling, it's not a floor. It means that, I would expect normal returns from the stock market, nothing out of the ordinary, for the next 12 months. If we were, 3,500, for example, under the same circumstances, I would say, we could expect abnormal outsized returns here. Maybe I'd want to overweight the amounts of stocks that I have. If we were at 5,500 on the other end, I would say this market's, take a crazy pill a little bit. Let's back off. So that's what I'm saying is it's relatively average. Now that being said, I do think that there's a lot of new risk that could reprice the market one way or another, which I don't think should be news to most people. On the second point, raising the short-term interest rate does not necessarily mean that you raise the longer-term interest rates. So we've seen this very recently where the yield curve is actually inverted. And what that means is that the short-term interest rates are higher than the longer-term interest rates. So what that means is that longer-term, the economy isn't expected to have as high as inflation expectations as they are in the shorter term. Now, that you could get there a variety of ways and a variety of paths, which I'm sure they'll argue on CNBC until they're blue in the face. But why it's important for you is that stocks are long-term assets and they're more correlated to something that's on the longer end of the spectrum. So if longer-term rates start to come down a little bit, it could actually buoy stocks. So that's why bad news is sometimes good news for the stock market. It can actually lower the long-term interest rate, and that could be a tailwind for stocks, all things equal.
So ultimately, that multiple, it remains likely that we'll stay in that range of a little bit outside the higher end of that long-term perspective shown on that prior slide.
Sorry, can you ask that again?
It seems likely then that we'll probably stay on the higher end for the multiples relative to this long-term average here, the 25-year, to say that, yeah, it seems likely that we're in the right range and it'll stay in that range for the multiples.
Well, I think it's a fair range for a couple of reasons. One, we're at a different economy than we were 25 years ago. An example I like to give is that Amazon went public in 1997, which was exactly 25 years ago. And I think that was, the beginning of the bits and bytes economy, and the beginning of the end of the brick and mortar economy. And why that's important is you get higher margins, you have more consistent cash flows in a bits and bytes economy than you do in a brick and mortar economy. So that ultimately deserves a higher multiple. Now, the other reason I think you're getting at is interest rates, and that's the other reason why it deserves a higher multiple than the long-term average. Our interest rates are well below the long-term average. So, for example, the Treasury rate in the late 1990s was north of 6%. Now, we're at 25 to 50 basis points. The Fed funds rate, I mean. So, again, against price relative to bonds, it deserves a higher multiple. Now, that could change by the interest rate picture changing. But even if that changed, I still think we're in a bytes and bits economy and not a brick and mortar economy, which should ultimately.
Thanks. Didn't mean to take it too far off track. Appreciate that.
It's all right. So, going back to that bytes and bits economy, we have some specific positions that are targeting mega cap tech names. And I just want to explain why. Relative to the historical values, they're very attractive and cheap. And that does not mean that they're going to correct in the next week or the next month. But I do think over the next 1 to 2 years, you should see these stocks particularly outperform the market, which is why we're tilted that way. That doesn't mean that we're not going to tweak it one way or another, but we do have some positions that are specifically targeting these areas. They're high quality companies, wide moats, great cash flows. These are not the tech names that completely fell out of bed. These are the Googles, the Amazons, the Microsofts of the world that we're much more comfortable with. That being said, you are widely diversified as well, and we're taking less risk in the overall market. Now let's go back to that fire and ice theme and talk about bonds. So this is what happens. The next two slides are about what happens to bonds in an ICE scenario, right? And by ICE scenario, I mean a disinflationary, deflationary type environment. Pretty much the exact opposite that we have today, but very common in any kind of recessionary scenario. So if you're expecting a recession or a significant slowdown, this is the kind of reaction that you might see from bonds. So these are exaggerated examples, but hopefully the point gets across. So this is what happened during the COVID crisis. I wanted to point out two things. The orange line is longer-term treasuries. We're not taking a lot of credit risk. We're taking a little bit of interest rate risk. They did very, very, very well. That was the position that you wanted to be in. They even had some volatility, though, during that bit of a liquidity crisis, but ultimately that's where you wanted to be. Now, the green line is floating rate fixed income. These have done very well recently, as you've seen, as we'll show, but they perform very poorly in a disinflationary environment. So I think what I'm trying to address here is, I think a common question would say, investment grade longer term bonds have done poorly. Why would you continue to be in them? Well, if in a nice scenario, you want to be in them. In a fire scenario, you don't necessarily want to be in them. And since we're kind of straddling both areas right now, we want to make sure that we're addressing both concerns. Now, here's another ICE scenario. These are bonds during the Great Financial Crisis. They did extremely well over the 3-year period that I'm showing here. But similar story, Treasury securities did excellent. While the green line there, the floating rate, had a significant drawdown. I'm looking close to 20% at one point. Eventually rallied back positive by the beginning of 2010. But similar scenario, during an ICE situation, you want to be in treasuries, you want to have some interest rate risk, and you don't really want credit risk. So here's what's going on today. This is the exact opposite scenario, where you see the green line's done pretty well because it's an inflationary environment and floating rate bonds, not a lot of interest rate risk. A lot of credit risk have so far held up better. While the orange line at the bottom, the treasury securities, have not necessarily done as well on a mark-to-market basis. So I want to point out what happened during the Russian invasion, though, which brought some fears of a nice scenario being pulled forward. We saw a sell-off in the credit asset, and we saw a rally in the treasury asset. So that's something that could happen if we move from the fire scenario that we're in right now to a nice scenario that could happen where there are some powerful forces, particularly the Federal Reserve, trying to push us that way. So all in all, I hope that helps you understand why you might want some longer term bonds, but we also want shorter term bonds. And we are currently very much favoring the shorter term bonds because as anybody who likes to listen to me regularly, I like to concentrate on what we know for sure, not necessarily on what could happen, but I want to acknowledge what could happen as well. So where are we? Where are we targeting? So the blue line is the yield curve today. You can see that it's very steep. You can see that if you invest for 3 years, you're not taking as much interest rate risk, but you're getting paid higher than anywhere else on the treasury curve. So that's where we are, quite frankly. That's where we're targeting. We're moving all the way up to the front end because we expect to get kind of a floating rate experience. As the Federal Reserve has told us they're going to raise interest rates, we're going to participate in that. And we're going to get paid more with very little interest rate risk as things move forward. That's especially going to do well in if the fire scenario continues. Now, we do have some assets on the 5, 7, 10-year part of the curve. And that's in case we have the ICE-like scenario that the Federal Reserve is trying to create. But ultimately, most of our assets are targeted around that 3-year, where we get the most bang for our buck. Now, let's talk about risk going forward. This represents a treasury curve. If I were to say, what do you get on an investment grade asset, which most of us have, you would put about 1.5% on top of that. So you get paid around 4.1, 4.2% on a 3-year bond. Now, if we had a 1% interest rate increase on the 3-year bond, you would still make money. And a 1% increase on a 3-year bond would be a significant increase. It's not like it can't happen, but I would say it's out of the normal base case scenario. So going forward, it is much more likely than not, I would say, that these bonds will perform, as frustrating as they've been recently. And this is a great way of demonstrating that. So the blue line represents the 10-year Treasury yield from 1941 to 1981, which was a rising rate environment for 40 years. You could see that it was near zero following World War II, and reached 14% by 1981. And you can see, especially during the 1970s period, which I think a lot of people are afraid of, we had very, very good returns from our fixed income portfolios. Now, what's important to note is not every single one of these bars is positive. Particularly in 1969, this chart estimates 3.2% decline. If you were in a BBB investment grade bond, it would be more like a 5% decline in a whole year. So that's 12 months. And I know we haven't even experienced 12 months here. We've only experienced 3.5 months. And I know it's very frustrating to think in 12-month increments, but I want to encourage everybody to try to do that as much as possible, especially when you're dealing with assets that are very long-term in nature here. But if you were able to suffer through that small decline, 3.2% in 1969, you would have had a 17% return in 1970. So, frustrating in 1969 for sure, but you got overwhelming reward in the 1970. So this is just a great way of visually showing people that even if you have one bad year, it's typically not as bad as you would see in the stock market. But it can also be followed up by some very, very good years. And the math makes sense there, right? Most importantly, you're going to get paid more. That's why it works. It's not like a stock necessarily where the economic circumstances can decrease with the business. They're contractually obligated to pay you the money. So as interest rates go up and the price goes down, you're objectively in a better position. So I want to talk about point-in-time performance because this has come up with a few clients, and I understand the frustration. So what happened was people would look at their statement at any given time, or they'd go on Morningstar or whatever, and they'd say, hey, I have a 50-50 portfolio or a 30-70 portfolio or a 65-35 portfolio. How come I'm doing just as poorly as the S&P 500 or the All Country World Index or whichever stock index that you want to pick? Well, the reason is that at any given point in time, they could have the same total return. So in this particular case, they were looking at year-to-date returns, and that's what I'm showing here. So you can see when I pulled this chart, the stock index was down 4.65%, and the bond index was actually down 5.96%. So when they looked at their statement, they'd say, I'm doing the same thing as the stock market year to date. And that's true. But what's important to point out is the drawdown for the stocks, the path to get to that was way more significant. And if you feel like, you want to see 14, 15% downdrafts during a war, then maybe you should be taking more equity risk if that's something you're comfortable with. But what I found is that most people aren't, and the path to getting there is very important.
I would comment also that one of the things that made this particular quarter challenging for people who had a more diversified portfolio is that it's the start of the year, as pretty much when things started to erode, right? We started to see some declines.
January 4th is when it started to go down.
And we hadn't really benefited from any previous upside to take some of the impact of that decline. And when it comes to the bonds, we haven't gotten the income that we expect over the course of the year, but we do see the measure of the decline in price that happened early. So, with time, we'll get the added benefit of the income, the yield that comes with those bonds. And that will help to offset some of the price decline that we've had. And given time, we think that will ultimately overcome those disruptions in price that will actually benefit from those bonds that we own.
Yeah, and finally, I'd just like to add on this slide that now this shows the aggregate bond index. Our bond selections perform better than the aggregate bond index, but this is just for visual.
In part because of what you were saying before, that we've been thoughtful about where we're placing our bonds on that yield curve, the kinds of bonds we own, and so forth. That there's a little better performance that we've been getting on our strategy relative to the index here.
Yeah, and this is just I'm visually going to go through here, and it's going to obviously point out some of the things I just mentioned. Now, this is showing that the greater the stock drawdowns will mean superior returns for allocations with less stock during time periods of stress. And we definitely saw that. I mean, if you were to run year-to-date performance through through the beginning of March, you would have saw that the less stock you were taking, the less stock risk you were taking, the better you did versus the index.
Yeah.
And finally, stocks can recover very aggressively. They can be down, it can be frustrating, and then they can pop right back up within a matter of days. And I think anybody who's been invested for longer than a couple of years has experienced.
Well, that's an important point to keep reminding people as to, if we've got a good allocation, a good strategy, why it is we want to stay the course, because things tend to move quickly. They don't necessarily come back as quickly as they fall usually, but you do tend to have quick movements with significant results.
So, Jeff Perry works for AMR, and he brought up a good question on the radio last week. He asked me, what are the things that I'm looking at? He thought I was going to say inflation and employment, and I'm obviously looking at all those things, but my answer for him was actually corporate spreads. So why did I think corporate spreads were important? Well, if corporate spreads blow out, if these lines all go higher, the purple one's high yield, the gold one is investment grade, if they blow out, bonds could look significantly more attractive versus stocks. And if that's the case, then you might see a rotation out of stocks and into bonds. The other reason, the economic fundamental reason, is it becomes more expensive for companies, municipalities, mortgages, et cetera, to be refinanced going forward, which could put a lot of companies and municipalities and sovereigns and everybody who borrows at a more significant risk. And finally, if you have to pay more in interest expense, your income's going to come down, your net income is going to come down, your E and your PE will go down, and that could affect the stock market as well. So these are one of the things that I'm looking at the most. You can see that during times of stress, they blow out a lot and quickly. Particularly the purple line there is the high yield. So there's a lot of risk in high yield. Don't let anybody tell you otherwise. There's a lot of risk in high yield, and this is something that we're watching on a regular basis. We're not necessarily getting paid for taking outsized risks right now. What I can imagine doing at some point is, if we do start getting paid a lot for taking a lot of credit risk, I'll take more credit risk and I'll take less stock risk, and that's a strategy that we've implemented in the past.
So right now, high yield is not a real part of our portfolio for that reason. We're just not getting enough compensation for it.
Yeah, unsecured high yield.
Unsecured, yes.
Yeah. So I want to reiterate that investing for the long term. I love this chart, and the thing I just want to emphasize is this is over 40 years. And again, I know those down ticks, they don't look significant over 40 years. But in the moment, in a 12-month period, it can be painful, and I understand that. But I've done my best to train my mind to think in terms of years, and that's how I think about your portfolios. I don't think about it in weeks and in quarters and in months. I genuinely think about it in years. And when we make changes on a quarter-to-quarter basis, we have multiple years in mind. We're not making changes because we think something's going to change on a weekly or quarterly basis. Finally, I went over this last quarter. I wrote about this for Retired Investor IO. War and Russian geopolitics, and they're not new. We were from World War II to the end of Vietnam. That's what this chart's showing. The S&P 500 during that time, it was about 31 years. The stock market did 4,611%. And it wasn't without dealing with a few recessions. There's 6 different recessions there. There were definitely some down calendar years. But if you were able to stick with that for the long term, if you were, 40 years old and when you came home from World War II and you invested to retirement, you made 4,611%. I'd take that. So let's talk about the risks, the opportunities, and the takeaways. I think the risks are obviously going to be on a lot of people's minds. And what we really try to do is build a portfolio that addresses the risks. Now, we don't eliminate risks. We try to address them. We try to mitigate them. But we also try to take advantage of opportunities at the same time. So that can be, that's a tricky balancing act. And I want to make sure that, I'm clear on what we're looking at here. Market risks and mitigation. Rising federal funds rate in response to inflation. This is, I think, on every headline and every newspaper in the country. Everybody knows this is going to happen, and it's a real concern. But how we're addressing it? Well, we're taking short duration to get paid more as rates rise. So I talked about how there's the front end of that curve that we want to be on during the fire part of the economy, and the longer end that we want to have some exposure to in case there's the ice part of the economy. Now, this is talking about the fire. We're going to overweight that portion because we're more concerned about the fire right now than we are with the ice. So we have the global slowdown caused by higher inflation from a Russian war. So we expect there to be a global slowdown because of the government spending, because of the inflation, particularly on the food and energy. But food and energy can hurt you in other places too. Like, for example, it takes a ton of electricity to generate aluminum. So you might have huge additional costs in something like aluminum. Russia is a big producer of nickel, for example, that goes into batteries for electric cars. So you can see how the inflation thing could continue and put a strain on the global economy. Particularly, we talked about the Eurozone region at the very beginning of this. So what are we doing? We're continuing to underweight international exposure with an emphasis on growth. Why do we emphasize growth? Well, I want to be in, it's generally a cyclical economy, the European Union. And I want the growthier part of those cyclical economies. So for example, ASML is a semiconductor manufacturing equipment company. They're historically a more cyclical company, but also historically over time grow very quickly. So we have a slowdown in deficit spending. We mentioned that. So this is part of the ICE situation, right? Things that can slow down the economy. The expected GDP is starting to slow. We're going to include longer term versus our main portion of our bonds. Intermediate term treasuries and investment grade bonds. We're going to barbell them. We're going to target 3 years, but we're going to have some at the very front end, and we're going to have some at the 5 to 10 year range as well. Higher inflation is cutting discretionary budgets. We know this, you know it, everybody knows it, and it would be foolish to ignore it. So what do we do? In Q1, we decreased the beta. So the beta is the measure of relative volatility in your portfolio. You might have noticed that even though all those stock indexes that we showed are down for the quarter, USMV, which is a low beta, lower risk stock index, was actually positive for the quarter. So that's one of the things that we did in Q1. We got out of consumer discretionary for the mega cap tech names. Even though mega cap tech wasn't positive, it did better than consumer discretionary. So that actually helped. We in Q2 we're decreasing preferred stock. So preferred stock works a lot like, even though it is technically an equity security, it works a lot like a very, very long-term bond, specifically for banks. And we're getting out of that. We're moving to the very, very short end. Now, this doesn't get as much headlines because I'm not quite sure that it's as important to Americans. But there's a real problem in China. There's a slowing Chinese economy. So they're having huge lockdowns because they've had a zero COVID protocol. They don't have any vaccines that are effective at all, and this could continue to drive a problem in core inflation going forward, which is something that we need to look at. But it could actually help things like oil and gas. So one of the things that's kept a lid on oil and gas recently has been the slowdown in the Chinese market. Now, we're doing a few things to address this specifically. We've limited our emerging market exposure, and we're going to continue. This is another reason to have the longer term intermediate treasury and investment grade bonds. It's something that could hit the ICE part of our scenarios here. So what are the market opportunities that are possible? So we talked about how a ceasefire would obviously be very good, right? It's the thing that most of us are concerned about in the world right now. I'm not going to redo it because a month ago in the previous financial planning webinar, I went through a scenario where I thought it could happen. If we have an increased supply of commodities, particularly oil, so a lot of this is going to happen in time. So U.S. shale production is going to ramp up. It's already ramped up. I know, there's not a lot of talk about it. There's more talk about how they haven't done it now. But if you look at from the beginning, the rig counts from the beginning of the year through now, it's up rather significantly. I think it was up 15%, 15 to 20% the last time I looked a month ago. So, this is going to happen over time. Higher prices are a cure for high prices because people will look for reasons to generate more supply of the asset in question. Iran could rejoin the Iranian nuclear agreement and add oil production to the market, and we could have greater output from OPEC to take advantage of high prices. Now, you could say I heard OPEC's not raising the output. That's not necessarily true. They actually have a schedule. They're raising it automatically anyways, and they actually raised that schedule by 10%. So they might not have raised it as much as people hoped, but they did raise it. They even raised it more than people expected. And the final point is the worst kept secret in economics is that the OPEC nations will cheat on their agreement. So if they feel like they can take the opportunity to produce more, they will produce more. Now, China joining the global community condemning the attacks will also put more pressure on Russia. It would make the rest of the world more comfortable with what's going on. I would add India to that example. Not as big of an economy, but 1.3 billion people. We could have a global slowdown, increased employment, decreased interest rates and inflation, and all that would buoy growth stocks. So this is counterintuitive, but if we actually have a decrease in interest rates because things don't go as well, it would actually be beneficial to growth stocks. Without getting into the technicals about that, that could very well happen. So finally, the takeaways. As usual, if you feel any unease about short-term risk, let's discuss your risk profile. I understand it's been a long bull market. People were feeling really good about their portfolios, did not want to take risk off the table, but I can't reiterate it enough. These things will happen. The unexpected happens all the time. So please, if you have any strong concerns about how your portfolio is positioned in the short term, let's have a discussion. Inflation is high, employment is strong, which is expected to continue barring a slowdown, but a slowdown is almost expected, right? We could see it through inflation, sanctions, China, and especially Fed policy. We're likely to continue to have multiple contractions if earning growth continues. We'll have more volatility. Now, the flip side of that is if earnings growth doesn't do well, we're likely going to have interest rates that have a ceiling on them. So I do think there's still a little bit of a Fed put here, a quote unquote Fed put that people think is gone. Inflation suggests that short-term bonds, we should increase. Commodities, we should initiate, which we're doing to some degree. Most everybody will have commodities in their portfolio if they don't already. While global slowdown suggests having longer-term bonds will maintain or decrease. So this is really getting at the fire and ice and how we're addressing it scenario. And remember that bonds are resilient. I understand that even bonds can be down for 12 calendar months, but over a longer term, they are much more resilient versus stocks, for example, and they can produce some excellent returns, especially now that we're getting some higher interest rates.
Okay, let me take this opportunity to remind you, if you'd like to ask a question, there is a Q&A button that you can use to write your question. Alternatively, feel free to raise your hand and we'll identify you as someone who may want to ask your question verbally. Brian, we do have a question from David. He says, what are the financial implications of Russia-China collaboration economically and politically to replace the dominance of the US, Western Europe, and the world in terms of currency, trading, and emerging economic powers in Asia, i.e. India et al., which have remained neutral in punishing Russia for invading Ukraine. So I think, we've talked about on the radio show a little bit about the currency issue, but maybe we can talk a little bit about this question of Russia-China collaboration, and is that something that's you referenced the idea of if China were to more likely condemn, is that a probability? Is that a likelihood? Seems like a stretch at this point. What do you have to say about David's comments?
Well, Russia isn't very powerful economically, which is why they're fairly easy to sanction, full board. Where China is powerful economically, but they're an export economy and they rely very, very much on the West to support their economy. They're going to rely on the fact that you're clicking on Amazon a delivery button for a long time, and it's going to get worse and worse for them on that front. So, they import all their oil, for example. We don't necessarily import all our oil. Most of it comes in on boats. If you're thinking that they can get it from Russia, they really can't. I mean, they'd have to build 3,500-mile pipelines because it's mostly wasteland between the Russian border and the Chinese border. What I want to concentrate on the most is the export economy, though. They rely on dollars coming into their country. There's something called the current account, and it's basically how you fund your country. And their current account is at risk of going negative over the next decade, especially now they have overwhelming problems in their debt markets. I mean, their household balance sheets are 2-3 times worse than Americans. Americans are very healthy balance sheets right now. China has some real problems economically. I think they're more concerned about staying in power right now rather than assisting Russia. If they were to cut off the West, they would cut off a good 6 to 7% of their GDP overnight, and that's just based on the exports that they ship to the United States and Western Europe.
The concern of Taiwan has been something that's been raised over the last 6 months with clients with us, particularly in the face of what's happening with Russia and Ukraine. It sounds like you think that that's a decreased probability today than it was maybe 6 or 7 weeks ago. Yeah, so I mean the Taiwan issue has been an issue since I think 1951. So we're over 70 years here where the People's Republic of China pushed out the Republic of China into Taiwan, and they have yet to invade them yet. I mean, they do look at them continually as rebels at the government level, but there's multiple generations from Mao Zedong that have died since then. So I think probably the appetite of going after Taiwan to a man in China is probably less. Now, to the point, it's not a democracy, it's an autocracy, so that's always something to consider. But I always keep coming back. It would be economically devastating to China. They're already dealing with a host of problems, and they just saw the whole Western world unite on devastating sanctions on Russia. And Russia, to their one thing that they have is they have a natural resource that's very, very important, right? They have energy that they export to the European countries. You could argue that China doesn't have anything that's overwhelmingly important, like a structural natural resource like that. Like I said, they import all their oil and they do it, via boat too. So yeah, I would say I'm less concerned. That doesn't mean that it's not a concern. I just think the probability is lower now that the West is reactive in such a united way. And it sounds like, the kinds of issues that David is bringing up are perhaps, more long-term in scope, but in the near term, maybe diminished as a particular concern. We talked about the issue of currency in the past. You sound like you have one more thing to add, but I'd like for you to also just briefly, offer a comment about the question that comes up from time to time. We saw some discussion about this with the Saudis and oil, compensation, petro yuan or something. So, the dominance of the dollar as the world's currency, is this something that's at risk?
It doesn't look at all like there's any evidence that it's at risk. Over 70% of, I forget the exact number, I gotta look it up, of all global transactions involve the dollar. And it's under 5% that involve the Chinese currency, which I can't pronounce. So no, I mean, there's no evidence that it's going to change. And the reason for that partially is going back to the current account issue that I talked about, where China is an export economy and the United States mostly exports dollars. So, why is that important? Well, back in the 1960s, the UK created something called the euro dollar, which meant that they would accept dollar deposits. It didn't have to be changed into sterling or euros or anything else. And this exists globally throughout the world. So that means that banks internationally are looking for dollar-denominated assets, which is why it's become the reserve currency of the world. And there isn't much evidence that that is subject to change anytime soon. I would agree that the current situation makes it more likely that a change will occur, but I'd still say the probability is very, very low.
We have a couple more questions here. One that's related to what we just discussed. Bill asks, it appears the presentation focused a bit on the Russia war, yet nothing mentioned about the impact of this administration's policies, i.e. basically pushing against energy exploration, blaming oil companies, pumping 1.9 trillion last March into the economy when it was not needed, et cetera. Inflation never was transitory. Well, we can maybe talk about what that means. And it started in early 2021, not 6 weeks ago when Russia invaded Ukraine.
Yeah,
so
I try
not
not
to unpack there, but yeah.
Yeah, I try not to talk too much about politics because everybody has different politics. And I wrote an article on Retirement Investor IO where it doesn't really help you to concentrate too much on politics. But I think Bill brings up a lot of good points. I would agree that the $1.9 trillion stimulus was not needed. I would have liked to see, I think when you give out money without production and an economy that isn't a deflationary economy, it doesn't tend to work. But I would, if you just to make it even politically, there was a Republican-backed bill just 1 month prior to that $1.9 trillion bill, which was $900 billion, which handed out $600 checks in December of 2020. I don't have a player politically on either side, but I just think it's important to point out that there was $2.8 trillion handed out in a matter of 2 months. So it was even worse, and I think both parties are partially to blame.
There is the point that energy policy has, transitioned a little, pretty much from day one. Will that reverse? Will that be as a consequence of the global circumstances with Russia being taken out of the market, so to speak, at least for the Western world? On the other side of the aisle, I'm sure there's concern about, climate considerations, but, isn't that something that seems likely to happen with increased production?
So I do want to talk about energy. So there's a ton of rhetoric, and I understand on either side of the aisle and I don't think the liberals are unabashed about this, that they don't like oil drilling. But I do think that it's mostly been rhetoric. And why do I say that? Well, as we're talking, I happen to pull up the U.S. rig count data, and I look back 1 year because, quite frankly, it was just easier to do. So the rig counts were 344 in 1 year ago on April 16th, 2021. And today they're 533. So that's up. That's a pretty significant jump. That's almost a 60% jump. This is all while Joe Biden's been president. I agree that the rhetoric is negative. And maybe oil executives are more careful than they otherwise would be to drill in fear for additional regulations. But drilling has increased almost in a straight line over the last year.
On the other side of the aisle, we've got Rick, who has a comment. You mentioned the slowdown of the U.S. government spending as a potential negative factor earlier. What about impact of the $1 trillion infrastructure bill passed and signed last year? You know, the implication of won't this be some favorable economic impact from the government spending? In addition, subsequent comment, Rick also said, not to mention the restocking of depletions of military arsenal resulting from aid to Ukraine. You want to hit on any of those points?
Yeah, so on the first point, that chart that I showed, the big decrease from 12.1% to I think it was 4.1%, that includes the $1 trillion infrastructure bill. So even with the $1 trillion infrastructure bill, you know, this is going to be a significant decrease. And part of that is because of the 2.8 trillion that we just talked about with Bill's question. And the $1 trillion is over 10 years. It's not all in 2022. It's over 10 years. So it's, you know, roughly $100 billion a year. So yeah, it'll partially offset the effect, but that chart takes it into account.
I love the
on the military spending. We've seen those stocks rally pretty significantly. So in the individual stock portfolio, we've owned Lockheed Martin, for example, for 3 years. We just liked that. We liked that it was good value. Had a long track record. We thought the price was depressed mostly because there was a Democrat in the White House, and the Ukraine war really spurred it on. So, you know, I mean, I guess I'll take it from that end. There are some positive things that can come from, you know, that's a really unfortunate event, at least from that point of view.
You know, I think one of the things that we didn't really talk about, you know, we did try to address the drivers that we want people to, you know, pay attention to, or what we're paying attention to. There's a lot to consider, a lot of variables. And by the way, I love the questions and appreciate the dialogue. Feel free to, you know, connect with us offline as well. If anyone else wants to raise a question, use the Q&A. You know, I think ultimately, Brian, you recently wrote an article about the challenge of when we're passionate about our politics and policy perspective, you know, that sometimes that can interfere with our perspective on investments. And we might just encourage people to check that out. I think it is still on the website as something that they can find. But, you know, I think let's talk about earnings, because ultimately, wouldn't we expect that eventually the impact of earnings is what we should be paying attention to for what's going to drive stocks? And what is the outlook as it relates to the prospects for earnings today?
Yeah, I mean, there's two factors, right? It's earnings and interest rates. If you're going to do a model, what every kid learns in business school is that you estimate out the cash flows and you discount it back by the interest rate. And so they're both very important. But when it comes to earnings for 2027, you know, we're still expecting 8 to 10% growth. That's
2022, sorry, you just said 2027.
All over the place these years. 2022, we're still expecting 8 to 10% growth. And in 2023, the consensus is expecting another 8 to 10%. Now, I think it's important to note that the earnings estimates are typically a little bit overestimated.
Overly optimistic.
Overly optimistic. So, you know, if it's looking at 8 to 10%, you know, even if you call it 4 to 6%,
4 or 5, yeah.
You know, that's and you tack on a 2% dividend. You know, you're looking at 8% returns without any contraction of multiples. So I think that's a reasonable estimate as usual. I mean, that's in line with the historical average, and like we said, we're at fair value. So in line with the historical average seems to be, you know, a reasonable expectation from here.
As we wind down, I would like to just reiterate some of the comments you talked about and have you maybe drive it home. Last quarter, we talked about risk and the importance of reviewing your risk appetite. Do we have the right asset allocation to meet your needs? Because inevitably, markets do move, there is drawdown, and we want to be in a position where we can stay the course. And so, when we have these kind of disruptions, it is a good test of one's true temperament. If you're finding that as you look ahead, you have a great deal of anxiety and discomfort, we'd rather deal with that sooner than later and have a conversation with you about that. So it's always a good time to review that with us. Secondly, your theme this quarter, Brian, has been about fire and ice. On the one hand, there are things that are happening, inflation and rising interest rates, and things we need to be paying attention to for how we structure the portfolio in the near term. But there's also the possibility that things could cool some when it comes to these issues. And there could be other positions of we want to have some exposure to the prospects of changing dynamics and longer term maturities in the mix. Anything you want to kind of drive that point and conclude remarks for you, Brian?
I just want to thank everybody again, as usual. I think we all appreciate the trust that you put into us, and I think the fire and ice theme is really hard for most people to wrap their heads around, but I do think that's a situation that we're in right now. So I really hope I was able to get it across, and I hope it made some sense. And I really think that we're positioned relatively well going forward.
As we put up the disclaimer comments for the remaining moments, I just want to thank you, Brian. Nice job, and thank our clients and attendees who have participated in our program today. We want to remind you that this webinar will be posted to our website, amrfinancial.com, later today. You're welcome to re-listen and share it as well. If you have any questions regarding your portfolio, do reach out to us. You can connect with us by phone, 866-771-8901, or certainly email or through the website to connect with us. Thank you to all who joined, and want to just mention, I hope you have a happy Easter or Passover if you celebrate. Thanks, everybody.